They're out up 3%, up 3%. Better than expected. That would be the highest level since the third quarter of 24 when it was up 3.1%.
Real GDP rose at 3% annually in the second quarter of 2025. That's for April to June, rebounding from a 0.5% contraction in Q1. Consumer spending and trade dynamics drove the rebound. Business investment in equipment slowed sharply from double-digit growth in Q1, while residential investment contracted for a second consecutive quarter. Real final sales to private domestic purchasers, a key measure of domestic demand, rose just 1.2%, down from 1.9% in Q1. Consumer spending increased 1.4%, up from 0.5% in the first quarter. The largest drag on GDP in Q1 was a decline in imports. In Q2, that reversed sharply. Import volumes fell at a record 30% annually, which improved GDP by 5 percentage points. Exports slipped modestly, offsetting some of the import-driven gains. The GDP price index, a measure of inflation, increased 1.9% in Q2, down from 3.4% in Q1. The personal consumption expenditures price index, PCE, rose 2.1%, while excluding food and energy, it rose 2.5%. And the overall economy grew at 3%, better than consensus forecasts at 2.4%. Analysts expect full year 2025 GDP growth to slow to around 1.5%, significantly below the Fed's estimated non-inflationary pace of 1.8%. Federal Reserve Chair Jay Powell.
Recent indicators suggest that growth of economic activity has moderated. GDP rose at a 1.2% pace in the first half of this year, down from 2.5% last year. Although the increase in the second quarter was stronger at 3%, focusing on the first half of the year helps smooth through the volatility in the quarterly figures related to the unusual swings in net exports. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles picked up from last year's pace. Activity in the housing sector remains weak. In the labor market, conditions have remained solid. Payroll job gains averaged 150,000 per month over the past 3 months. The unemployment rate at 4.1% remains low and has stayed in a narrow range over the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance and consistent with maximum employment. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in June, and that, excluding the volatile food and energy categories, core PCE prices rose 2.7%.
The U.S. economy, at least on the surface, appears to be doing quite well, especially when you consider the recent rebound in GDP growth following a contraction in Q1. Consumer spending has picked up, inflation is easing, and trade dynamics, while volatile, seem to be settling out. Let me know your thoughts.